Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. And on a good day for the markets, let's pull up the case for a chat to just establish what, amongst others, we'll be talking to our guest today. We will ask about whether high-end real estate is going to face a price correction and could that be negative for real estate companies. A Knight Frank report certainly seems to believe that there will be a correction. We'll talk about the impact of the same. Are chemicals starting to steal the spotlight? For the longest time, the last 3 years or maybe more, the chemical sector has been in a bit of a slumber. Can that change in the times to come? Are IT companies hinting at a recovery? We've heard from TCS and Tata Elxsi. We'll probably hear from HCL Tech today. It'll be interesting to see what our guest today thinks of the same. And of course, no conversation in the current times can be complete without talking about the China impact. To talk about all of that, Ashwini Agarwal, founder of Demeters Advisors LLP, joins us right now on the show. Ashwini, always good talking to you. Today is no different. Thanks for taking the time out.
How are you doing?
Very, very well, Ashwini. Thank you so much. I hope you're doing well too. But for the longest time, you've been talking about how there needs to be a return of some sanity in the markets. You could argue maybe that it's not completely that way, but certainly the last few weeks have shown that the markets need not be always a buy on dips. At times, it can actually follow the sell the rise template too. We've set the cat amongst the pigeons if the pigeons were bulls.
So you're absolutely right. And I think, we are just starting to see, sanity creep back in, as you say. I don't think there's a deep correction in the offing, but I would venture to think that, we should brace for something similar to what we saw between September 21 and March 23, which was an 18-month consolidation back then, and about 15% in terms of Nifty index, if my memory serves me right. Now, this time around, it might be shorter and the number of 15% might be a little bit different. It could be 10 or 18, who knows. But I think we are set for a little bit of a consolidation. And I think there are multiple reasons. One is, which I have been talking about for the last 3 or 4 months, is the intense supply of paper. I was reading this report done about how much money has been raised in the first half of this year, and it's about 1.5 lakh crores. And this is, this doesn't include offers for sale from existing investors or promoters. This is purely QIPs plus IPO money. And this is a pretty significant number. So, even if you assume a very, very big $70 to $75 billion incremental allocation to equities from domestic households, which is direct plus indirect via insurance companies and superannuation and so on. If you put all of it together of 75 billion, this in the first 6 months of about roughly 18 billion is a pretty substantial number. In addition to that, you started to see foreign selling. People allocating away from India into presumably China. I don't know for certain, but that would appear to be the case. And then you also have valuations which are not very expensive, but bumping around the +1 standard deviation. And you have slowing earnings growth. So you put all of this together, and I think it's time to see some correction. Time correction for sure. Price correction, I'm less certain about.
Ashwini, for the longest time, the reasons were always there. The factors were not adding up. And one of the reasons why the markets got bought on dips at all times was that while FI inflows were missing, but the DI flows were strong. We still have the DI flows looking okay, but there are FI outflows now, and which might have led to the corrective move in the recent past. My question is therefore, that what could be the factor that would lead to this correction while the reasons are there? Would it be continued FI outflows, or would it be the domestic money taking a bit of a pause?
It'll be both, Niraj. See, at the end of the day, the markets are decided by the marginal buyer or the marginal seller, right? So as the supply keeps increasing, and the supply is from new papers, the supply is from existing investors, whether it's promoters or FIIs, and it's counterbalanced by the domestic money, which has been the holding the fort on buying. So as the supply keeps increasing, at some point in time, the supply takes over, and then we find answers as to what is the reason why the market is falling. Then we'll point to earnings growth, we'll point to the uncertainty in the Middle East, we'll point to oil prices, we'll point to all sorts of things. The reality is it's all demand and supply. Okay, and as supply keeps increasing, it makes the market it makes it difficult for the markets to continue to go up. And at some point, the domestic investor, especially the retail participant, driven more by momentum than by anything else, he starts to wonder if he's in the right place. And that's when you see a big step down. So we haven't seen that happen yet. But we may, who knows?
Okay, okay, noted. So, okay, we might actually have some words from the Reserve Bank coming soon as well. So we'll try and get you that. But what about policy decisions, Ashwini? Are you kind of constructive there? Are you negative there? What's your sense? I mean, the RBI showed its hand, not in a rush, but is that a positive thing, or from a rate sensitive perspective, you would have hoped for some more clarity and maybe some more action?
No, so Neeraj, yes, while the market was hoping for a 25 basis point cut, I don't think it was a consensus view at all. And I think there were a lot of people who expected no change. I mean, inflation is one aspect, geopolitics is the other factor. And inflation report, even in the US, which is driving this whole narrative about lower rates, are quite mixed. I think in the domestic environment, growth continues to be reasonably okay. I think policy decisions have been fairly supportive from the government, at least, whether you talk about what they're trying to do, trying to bolster the economy in whichever way they can. But the reality is that a lot of things have run their course. I mean, the government can't keep spending more and more money on infrastructure on a year-on-year basis. I mean, fiscal consolidation is the right path to go. I think on the policy front, the only thing that I would hope for is a little bit easier money supply. I think the base money growth has been a little disappointing, and that's kept liquidity very tight. And there I would have expected some relief. So now with the rupee breaching the 84 mark on the US dollar, if the RBI starts buying the currency and releasing some liquidity into the market, we might see some relief there. But that too depends upon how RBI thinks about liquidity at this point in time. They've changed their stance in the policy, so that's something that I'm looking forward to. But let's see how it unfolds.
Got it. Okay, Ashwini. So let's assume that you were sitting on some bit of cash because you were admittedly talking about caution some time back. I'm presuming that from what you've told me today, you're not in a hurry to deploy. But
absolutely.
If there are some decent numbers that come out in Q2, because while the headline may look soft, but that is because of cement and oil and gas or energy. Otherwise, the other sectors may actually post in decent growth. Where is it that you are looking out for earnings performance, which might prompt you to put in some dry powder to work, even as you are maybe not as constructive on markets?
So, Neeraj, I don't think there are any standout sectors where you see an incredible amount of value, barring financials. And financials have been quite undervalued relative to their own history. And even the microfinance companies have sold off quite a bit in the last 3 months. So, that's one sector that kind of stands out in terms of value relative to the rest of the market or relative to its own history. But barring that, there are really no sectoral standouts which one can point to. But I will tell you this, that on a bottom-up basis, there continue to be some ideas that get generated. Not a lot, but some for sure. And I think, given how I look at things, I typically try and look at stocks that are still haven't participated in the rally that we have seen in the last 2 years or what we've seen since COVID. I mean, since COVID, everything has participated. That would be wrong. But I think there are stocks that haven't participated in the rally of the last 2 years, and I'm looking at them and figuring out if there's an opportunity there. So it's harder and harder to find bottom-up ideas, but I do find some, and that's what I'm doing. The other place where I'm personally quite excited about is the private space, especially mature companies that might mature from an IPO perspective, that might go to public over the next 2 to 3 years. I think there are opportunities available in that space. Ticket sizes are higher, so for many of your viewers, the access to those transactions may be difficult. But that's another place where I see a reasonable amount of value to put some money to work.
Okay, okay, okay. So, that's interesting to hear from Ashwini Agarwal that there is not too much, there are not too many pockets wherein there is value. Do you find value in growth, Ashwini, though, anywhere? Because, I mean, the estimates seem to suggest that EMS, for example, the growth numbers will be solid. But somebody was cautioning me on Friday that if you just look at the cash flow converted EBITDA to CFO, those statistics are abysmal for a bunch of these EMS companies. I'm just trying to understand, how do you think of that bucket, considering that the reported growth will look okay?
So, I'm a big slave of cash flows. So, growth without cash flows is not something that appeals to me unless you're in very early stage of a very long growth cycle. So EMS obviously makes the cut in the sense that, it might be a 10, 15-year growth story or 20-year growth story, but the valuations still don't appeal to me. So unfortunately, I'm not invested there. In hindsight, obviously, one wishes that one had. But I'm a value investor. I'm an old-fashioned guy, so it's okay. I'll eat I'll partake of something else in the 1,000 dish buffet that we are at.
Okay. And viewers, it's interesting because sometimes when you buy into overvalued stocks, and I'm not saying that this stock was overvalued, but it certainly is rich in valuations, and there has been a bit of a disappointment today, as a result of which Avenue Supermarts is bearing the brunt of some serious selling pressure. Now, before I ask Ashwini Agarwal about his view on maybe retail, there's a clutch of names out there which are doing really well. Let me get in my colleague Mahima, who joins in with telling us as to what Avenue Supermarts did and what is it that the sell-side view is on the stock, considering that it's been bludgeoned out of shape in trade today. Mahima, good morning.
Good morning, Niraj. So basically, revenue Q2 numbers were a complete miss in terms of estimates. And in terms of margins have taken a hit from 8% to 7.6%. And what was the highlight was that the management has said that now they're seeing, their business being impacted on account of online grocery new formats. So it's the quick commerce that is kind of affecting their like-for-like growth. Now, multiple brokerages have come out with their view on Avenue Supermarts, and the views are mixed, of course. To start with, Citi and MS, who have remained underweight as well as have given sell ratings. Well, they're the most bearish ones. Citi has maintained sell with a target price of 3,500, and what they've said is that EBITDA and profit before tax growth has lagged revenue growth in 7 out of past 8 quarters, and they've also trimmed their EPS estimates by 4 to 6% for FY25 to 27 estimates. And valuation as risk to reward seems unfavorable at 82 times. Now, MS has downgraded it to underweight with a target price of 3,702, and what they're saying is that online and offline can coexist, but defenders cannot stay defensive. Now, this was the highlight of the report, and they've lowered the top line growth estimates by 7 to 18%. Now, Motilal Oswal has reiterated buy rating and given a target price of 5,300, and they're estimating a CAGR of 17% and 20% respectively on revenue and PAT over FY24 to 27, and they've cut estimates of EPS by 8 to 14%. Now, Nuvama retains hold with a revised target price of 5,040. What they're saying is that DMart Ready's growth slowed at 22% YOY versus that of 32% in FY24. Bernstein has the highest target price at 5,800 with outperform rating. What they're saying is that one quarter results does not indicate a shift in DMart's long-term story, and they believe value-seeking customers will remain primary purchase driver for the large part of India. CLSA on Avenue Supermarts, well, again, they've rated it outperform with a target price of 5,650. What they're saying is that they believe DMart is making appropriate pivot to private labels, and this will meet future growth for the company. And lastly, Macquarie has rated it outperform with a target price of 5,600, and they're saying this Q2 is a miss and commerce concerns are cited by the management. So this is the overall view of how Q2 numbers have panned out for Avenue Supermarts, as well as what sell-side brokerages are saying about Avenue Supermarts.
Comprehensive indeed. And Ashwini, I'd like to come to you on this. Now, one swallow does not a summer make, but certainly lays out the perils of investing in a high-growth business wherein a quarter of growth gone, and maybe Avenue Supermarts will bounce back. It's a fabulous business run by a fabulous guy. But for somebody who's tactically got in, is really licking his wounds or her wounds um, because of the high valuations and now the inability to show growth for a couple of quarters now.
So, Neeraj, this is my whole reason why I, hate or why I dislike investing in stocks that have very high multiples, whether it's price to sales, price to book, price to earnings, EV to EBITDA, whatever you look at. Principally being that the room for disappointment is very low. And I tend to kind of go where value is, so your downside is protected, hopefully, and you make a lot of money if you're proven right and the business is doing better than what the street thinks. So it's always about betting on what your view is versus the street's view when you're doing bottom-up stock picking. And this is clearly a situation where expectations were not met, valuations were rich, and that's why you're seeing the pain today. So we don't know what happens in the long run. But the other point I'd like to make on consumption is that I'm continuing to see very mixed trends in consumption. I mean, the K-shaped much talked about the K-shape recovery that we saw post-COVID continues to have legs with stronger demand for more expensive luxury products and kind of weaker aggregate demand for bottom of the pyramid products. I think two-wheelers is an exception, but outside of that, I'm not seeing a lot of traction for demand. And that's quite puzzling, actually, because I had thought that election spending will provide some boost to rural demand. Monsoons have been very good. Inflation is reasonably well behaved. Um, so I don't understand it, and this has been bothering me a little bit, and I don't have an answer.
One of the things that was noted, though, Ashwini, is that quick commerce growth is continuing unabated, even if organized retail might be facing in select pockets, a problem or two. Trend is not showing any such problems. Some of the others might be, and that's another stock with such massive multiples. But of course, the growth is there. But here's my question. Therefore, while there are some puzzling things there, is quick commerce still a pocket to look at seriously, simply because the growth numbers are looking very, very strong for both the listed and the unlisted ones?
Absolutely. So you're right. The problem in the consumer retailing has been the disruption caused by quick commerce, and quick commerce is here to stay. I mean, all of us are getting used to ordering on the Blinkits of the world. I mean, who doesn't like a 15-minute delivery? And I think it's here to stay, and it'll probably gather momentum. Let's see how this unfolds, and there is a path to profitability that some of the people in the private space need to find. But so for now, the growth is so good that funding the losses is not going to be a problem. And for the moment, this market share shift from modern retail to quick commerce, or from traditional kirana to quick commerce, will continue. I don't think there's any way out. I mean, I think this is a reality.
Wow. Okay. Select names bankable in the quick commerce space, Ashwini. I'm just trying to derive the final answer here.
Could be.
Could be.
Valuations
Okay.
are expensive, but you could get to eat the growth. I don't think you will get to see multiple expansions, but you could get to eat the growth, and growth's going to be pretty good.
Got it. Now, you talking about different pockets, let's say, or sticking partly to consumption, in the midst of presumably a long cycle, which is Indian real estate. I read a report from Knight Frank over the weekend that high-end real estate prices might be set to correct. It doesn't show in the demand numbers that are happening across various companies which are launching projects, NCR, Mumbai, where have you. Trying to think about how you are thinking about this pocket, because you were an early investor, I know, into some of the NCR companies, maybe MMR too, I don't know, but certainly NCR. What is your view on the attractiveness or the lack of it of real estate companies now that there has been a bit of a rally into some of them?
So interesting question, and I've kind of been puzzled by it as well. That how many people are there in India who can afford to buy homes that cost $5 million or more, and it's incredible some of the prices for new offerings that are being charged. Uh, there could be some consolidation available, possible. But also there is a very high correlation between stock markets doing well and real estate doing well. And if you go back to the argument that, look, you're not in for a very deep correction. You're probably in for some time correction and probably single digit, high single or low double digit correction in terms of prices. Then I think the tailwind that many people who have been invested in the markets for a while have in their personal fortunes will continue, and therefore their ability to pony up for homes. If you recall our initial conversation, I'd said that a good home is a basic and is a basic human need, and something that is the first uh, port of call for saving. So when you look at people who make a substantial amount of money through a private company being listed or through options of having worked in a startup, I mean, it's natural to expect that they will go and buy themselves a good home. So I think the underlying demand trends will continue. Maybe you won't see the price appreciation that you have seen in the last 2 or 3 years. I mean that's how I think about it intuitively. I don't see a massive sell-off happening in real estate. Something akin to what we saw in '96 to 2003, or something that we saw from 2011 to 2020. And the reason is we are not seeing higher rates. We are not seeing higher interest rates. We are not seeing a massive amount of bubble in some other part of the economy, which needs to be deflated. I mean, historically, real estate falls have been accompanied by a downturn in the economy, and I don't see that happening.
Okay, you don't see that. Okay, so therefore, suffice to say that Ashwini, you're not negative on real
No.
estate thus far. And viewers, there are enough reasons. I think our producer showed the chart of how real estate inventory as well is essentially not very high in the system per se, and therefore that could also be a big thing to monitor. Ashwini, the other point is chemicals. And for the last 12 months, I've been listening to the possibility of good times because the sector was consolidating for such a long time. But the China pressure is here and real. Dumping is still on in select pockets, as promoters tell us as well. I'd love to know how you are thinking about this bucket, because sporadically we see these, like the Sudarshan Chemical announcement or the acquisition, etc. An announcement here and an announcement there. Capacities are coming in. The stocks aren't quite moving. They're not showing results as well.
I think you have to be a little more longer term in your view and look at the positioning of a company in its space. Where is it adding value? What is it doing? And what do you expect 3 to 5 years from now? So what I would say is that the way I think about China is that from a top-down perspective, what China wants to do is more in terms of uh, of new technology, innovation, value addition. They're really not interested in supplying bulk chemicals to the rest of the world. I think some of the pressure will continue in the short run because they have capacities and the capacities will keep churning out. So that might happen. But in the longer run, that will not hold true. And what the Indian companies have done is occupied niches where they can add value through domestic chemistry skills, ability to manufacture quality product at a lower price than the West can. And this whole China plus one narrative has allowed people to come and look at India a little more closely. So I think there is an opportunity there. You have to be very bottom up. We have to be very stock selective. But I'm quite constructive on this space. Actually, I think there's a lot of value that will be generated in the years to come. It may not happen across the board. It might be very selective, but I think it will happen. Also, what you will see is margin normalization happen because, you went through 2 or 3 very tumultuous years post-COVID where initially end product prices ran up and abnormal profits were made by domestic chemical manufacturers because they had low cost raw material inventory. And then raw material prices went up and product prices crashed and you had a shipping crisis. So, you had this massive yo-yo in margins where you had abnormally high margins and then abnormally depressed margins. And I think now the margins are coming around to what they are sustainable. So now you will start to see growth from projects become visible in earnings. So I'm actually quite positive.
Okay. Ashwini Agarwal, on that note, we'll call it a day today, but thank you so much for taking the time out and being with us. And from all of us, wishing you a great festive season. Hopefully talk to you around the Diwali times.
Thank you. Thank you, Neeraj. Wishing all your viewers and all of you at the channel the same.
Thank you so much. Well, but with that, it's a wrap on this leg of Talking Point. Thanks so much for tuning in.